Hi there, gangs. PowerCycleTrading.com. In this video, I want to show you a really cool trade setup that we did today. This was on FSLY. So just happened to scanning through some different stocks and came across FSLY was up when everything else was down. So taking a look at it, it was starting to break out. So then we looked at the what we call the horizontal implied volatility skew, and we had a positive skew. So I'm going to walk you through exactly what that means, what we did. So we basically set up a long trade on FSLY and did this trade with the calendar diagonal. So you can see it started breaking out early, and there was some reports out that they were going to maybe be taken over by Cisco and things like that. So it really started ripping higher towards this 100 level. So by the time we set the trade up, it was trading right about 94 up to 96. But what we did, we took advantage of what we call the implied volatility positive skew, where the near term option is higher in the implied volatility than the option series behind it. So we were able to take advantage of that for a really nice calendar diagonal spread. So let us take a look. I'll walk you through the trade. First, here are the basics of a calendar diagonal spread. So when we look at the calendar diagonal, what it does, this trade captures time decay without completely sacrificing directional speculation. So the big benefits of the calendar diagonal is that it benefits from the difference in the rate of time decay between your long option, and which expires further out in time, versus the short option, which is closer in. The other benefit is it's going to benefit from correct speculation on price direction of your stock or security that you're buying or selling, and it's also going to benefit if you have what we call positive horizontal implied volatility skew. And what that means is where your near-term short options implied volatility is higher than your long option, the long options implied volatility is lower. So you'll profit from that when the difference of that short option goes down, its implied volatility goes down, that rate goes down faster than the one behind it. All right. Plus, you're going to benefit from theta decay. So let's take a look. So when we originally set the trade up in the morning today, this is on the 8th of December. What we did, we went out and bought the 18 December 95 call right here. All right, and you can see the implied volatility at that point in time was trading at 89.64 implied volatility, and then we sold at the exact same time the 100 strike here call in the 11 December, so closer in, and the implied volatility on that was 111.21. So you can see the big differential. It's about 12.31, over 12 basis points higher for the front implied volatility. So that's why we call it positive implied volatility skew. Now going out today into the close, you can see how this dropped. So it was 111 in the morning, and then it just dropped down to 98.9 in the afternoon, and the implied volatility of the back option went up. So that's the perfect kind of scenario. Plus, we get the benefit of theta decay. So we get the benefit of theta decay. So you can see here that the December 11 series, the $100 strike call, that's the one we sold short, has a theta of 62 cents in the morning. And the 95 call that we went long on the 18 December had a 27 cents. So you can see that differential. So we're getting that delta between the option theta. So that's the other benefit. So positive theta differential and positive implied volatility differential. So it makes it a great setup to buy, in this case, the 18 December 95 call, sell the 11 December 100 call, and this is what it looks like. So we got into the spread this morning, buying the 18 December 95 call, selling the 11 December, so that's closer in. That's this Friday's expiration 100 call, and we did it for $355 or $355 per spread debit. So it's a debit cost, that's your max risk. Now when this market shot up and it went up to $100, when it was trading up here at 99, this was a good area to take some off, and at that point in time this trade went from $355 to $465, so it was up about $110 per spread on that spread changing in value. All right, so then on the close today, it went out about 95.94. So let's take a look at that, where it currently went out. So here it was, the actual setup was buying the 18 December 95 call. At that point in time when we picked it up this morning, that was going at $670, so $670, and then at the same time selling the 11 December 100 call here for $315. So that's your $355 debit cost, and then it went out today $760. You can see the 95 call went up in value, the implied volatility actually went up on that one, and the 100 short call that we sold for the 11 December actually went down in value. So that's the perfect kind of scenario with this type of trade. And then there are other things we can do with it. The other thing we did with this trade today was was we were able to, when everything was shot up and implied volatility started coming off, a couple other things, we were able to do an adjustment into a free butterfly. So this is how that worked out. So the other thing we were able to do is we were able to close out the 11 December, which is not showing here, at a break even. So that then puts us back just into the 95 long call for next week at 670, and then turned around and sold the 18 December 100 call against it. So there you have a call debit spread. But then we added one more leg. We sold the 100 105 bear call credit spread, all right, for $1.65, and that creates a butterfly. And now this is a free trade with actually a credit of $65. If it was to crater to the downside, 65. If it went straight to the upside, we make 65. If next Friday, not this Friday, but on the 18th, it goes out up here at about 100. This makes over $530. So really fantastic strategy. A lot of different ways you can do it, and that's the beauty of options. If you'd like to learn more about these types of trade, make sure to join us at powercycletrading.com. Good luck trading.